Hey, fellow investors, Iggy here, your go-to iguana for navigating the Singapore stock market. We've been climbing the ranks and hitting incredible watch hour milestones, all because we cut through the noise and focus on what really matters, how global trends impact our SGX portfolios. Today, the market is serving up a classic mixed grill. We have some banks surprising us, for better and for worse, a few REITs making money moves, and a property newcomer that has everyone talking. Let's get into it. The Straits Times Index, STI, inched up 0.60% to close at 4,444 points. It feels like the market is holding its breath, waiting for a clear direction. While the big picture is cautious, the real action is in the company-specific stories. Let's dive in. The big news from DBS is a solid third-quarter performance. Net profit dipped a tiny 2% to $295 billion, which might sound like a downer, but it actually beat what analysts were expecting. The bank's total income hit a new high, and the profit was only lower because of the new global minimum tax. To top it off, they've declared a regular dividend of $0.60 per share, plus a special dividend of $0.15. This is a strong showing from DBS. Don't let the small profit dip fool you. Beating forecasts in this climate is impressive. The new global tax is something all the big players are dealing with, so it's not a DBS-specific problem. That extra $0.15 dividend is a nice little bonus for shareholders. It shows that DBS is confident in its capital position and is happy to share the love. For investors, this is a sign of resilience. The bank is navigating the global environment well and still rewarding its shareholders. What's the story with the other big local bank? UOB's quarter was a different story entirely. The bank reported a massive 72% drop in net profit to $443 million, a huge miss compared to the $1.34 billion analysts had predicted. The main culprit was an 8% slide in net interest income, as their net interest margin got squeezed, falling from 2.05% to 1.82%. Ouch, there's no sugarcoating this one. A miss this big is a major red flag, and the shrinking net interest margin is the smoking gun. It tells us that the bank is earning less on its loans compared to what it's paying out on deposits. The question for investors is whether this is a one-off shock or the start of a worrying trend. UOB has been a reliable performer for a long time, but these numbers demand a closer look. I'd be watching their next quarter's results very carefully to see if they can turn things around. From banking woes to property disputes, let's see what's happening with PropNex. PropNex is in the headlines again with its subsidiary facing another lawsuit. This time, they are being sued for over $586,000 related to a breach of duty by one of their salespersons. This marks the fourth high court lawsuit against PropNex Realty this year. Interestingly, the stock price actually ticked up slightly before this news broke. One lawsuit is a headache, 4 in a year starts to look like a pattern. While the financial hit from this specific case isn't huge for a company of PropNex's size, the reputational damage could be a bigger issue. The real estate game is built on trust. If buyers and sellers start to feel that they can't rely on PropNex agents, it could hurt their business in the long run. The stock might be holding steady for now, but investors should ask themselves how many more of these headlines they're willing to see before it starts to impact the bottom line. Let's switch gears to a new listing that's getting a lot of attention. LHN's co-living business, Kalawu, just had a blockbuster IPO. The public offer of 5.3 million shares was a staggering 20.7 times oversubscribed. With nearly 2,800 applications, it's clear that investors are excited about this one. The shares are set to begin trading today. The hype is real. Co-living is a hot trend, especially in a space-starved city like Singapore. The massive oversubscription for Kolawu's IPO tells you that investors are betting big on this model of flexible, community-focused housing. For LHN, spinning off Kolawu looks like a smart move to unlock value. For new investors, the challenge will be to see if Kalawu can live up to these high expectations. It's a great story, but the proof will be in the profits. How are our REITs doing? Lendlease REIT just flexed its fundraising muscles, successfully raising $280 million in a private placement, which was even more than the $270 million they initially targeted. The new units were issued at 0.60 each. The REIT's trading halt was lifted this morning. When a placement is upsized, it's a sign of strong demand from institutional investors. They see value in Lendlease REIT and they want in. The key question is what they plan to do with the fresh cash. Usually, it's for acquiring new properties or upgrading existing ones, which can lead to future growth. For existing unit holders, there's a small amount of dilution, but if the money is put to good use, the long-term gains should outweigh that. Stoneweg, which invests in European properties, saw its distributable income fall by 4.6% to 57.6 million euros, even though its property income and revenue went up. The trust blames the drop on asset sales and higher interest expenses. This is a classic case of more revenue, less profit. It shows how rising interest rates can bite. Even if your properties are bringing in more rent, higher loan costs can eat away at the cash available to pay out to unit holders. Stoneweg's strategy of selling off some assets might be smart for the long term, but in the short term, it means less income. It's a reminder that not all revenue growth is created equal. Finally, let's check in on a local property developer. Bukit Sembawang posted a 25% drop in net profit to $47.2 million for the first half of its financial year. The main reason was a big 61% fall in revenue from its property development segment. They did not declare a dividend for this period. Property development is a lumpy business. Developers make money when they complete and sell projects, so their revenue can swing wildly from one quarter to the next. The big drop in revenue isn't necessarily a crisis, but it reflects a quiet period between projects. The key thing to watch is their pipeline. The company mentioned new launches like Pollen Collection 2 and Luxus Hills Phase 10. The success of these future projects will determine if this is just a temporary lull or a sign of a deeper slowdown. So what's the big picture for us retail investors? Today's mixed bag shows that you can't just bet on a sector. You have to pick the right companies within it. DBS is showing strength while UOB is stumbling. PropNex is facing legal headwinds while Kolawu is riding a wave of IPO hype. It's a reminder that we have to do our homework on each and every stock. Don't just follow the crowd. Dig into the numbers and understand the story behind them. That's all for today's digest. What are your thoughts on UOB's big miss? Are you buying into the Kalawu hype? Let me know in the comments. And if you want even more in-depth analysis and exclusive content, don't forget to sign up for my premium newsletter. Keep those portfolios growing, and I'll see you next time.